stand exactly here because we got a device on right now recording this that follows my every move. It shows you technology really is moving ahead in a rather extraordinary way. One of the things I tend to do is go around Canada, the U.S., and various parts of the world and talk to businesses and many schools actually in my travels, and basically try and get an idea of what's happening in the world today and what impact it's going to have on Canada. And I will tell you, in the last 6 months or so, things seem to be pretty confusing. If you're looking at what's happening with the Canadian dollar, which about 6 months to a year ago was closer to parity and is now below 90 cents. If you're looking at the job market in Canada and where growth is occurring in Canada, things have changed fairly substantially. So what I'd like to do is just do a general overview as to where we see things going from an international point of view, because I represent a bank that is in 58 countries around the world, and then open it up to questions and really find out what you're interested in. Many times when I'm talking to student bodies, the big issue is jobs. Where are they going to be created, and where are the best employment opportunities? You are living in the best province in Canada and probably the best area in North America in terms of job creation. But I can cover that at the end as well, because we do a lot of issues with respect to skills, with respect to where there is a lot of demand for employment, and maybe that may provide a little bit of insight to you as well. But let's start from the beginning. You may remember we went through a vicious financial crisis in 2008. It was something that in my lifetime I had never seen before. Financial markets were in turmoil. There was a lot of job loss right across the country, including in Alberta, and particularly in the U.S. and in Europe. And it became quite apparent after about 2008, 2009, that Canada really was special, because unlike the type of brutal setback that we saw in the United States or in Europe, Canada was doing reasonably well. And the reasons for that were fairly straightforward. We had a strong financial system, that's the area that I work in, but we were a resource-rich country in a resource-short world, and the resource sector was actually doing pretty well because of global demand. We had a situation where we quickly got back to record levels of employment, and we still enjoy them today. When you look at governments, our governments, well, certainly in Alberta, in BC, and Saskatchewan, very strong, and at the federal level, the deficits, the financial stress on governments was a lot less here than it was in the US or in Europe or Japan or many other parts in the world. So we really were seen as special, and when I traveled abroad, people were always asking how we were able to achieve this success. One of the questions I also got when I was traveling around was our housing market, which many people thought would collapse the way it did in the US and in Europe. And they were wondering not only why it was special, but when the Canadian housing bubble was going to burst. And I would tell them, given the fundamentals, I didn't think that was going to happen. But the mood towards Canada was much different than the 40-odd years that I've experienced doing economic forecasting and traveling around the world. And the special nature of it was Canada really was in the spotlight in terms of a country that had done things well. But things have changed a little bit. And it's not so much that things have changed in Canada, because we're still at record levels of employment. We still have the strongest banking system in the world. We still have governments that are more prudent than many other parts of the world as well. And I could go on and on with a variety of things like that. What has changed really is the world. The world over the last 2 years has shifted in many ways, and in order to see that, I'd like to briefly talk about 3 areas: the United States, Europe, and Asia, to see what changes have occurred. The one that matters most to us is the U.S. The U.S. takes 3/4 of Canadian exports and is the biggest influence on our economy. It has been all my life. And that economy has begun to grow again in a way that some people hadn't anticipated. Car sales in the U.S. are moving up to record levels right now. Employment is growing 3 times as fast as it is in Canada. They're back to record levels of employment now for the first time in a very long time. You've got to realize that the U.S. lost 9 million jobs during the setback after the financial crisis. They finally filled in that hole, and they are at record levels of employment. Consumers are spending again. Businesses are investing again. And it's not as though the U.S. is without problems. For example, in their housing market, of the families that actually own homes, about 15% of them still have a mortgage bigger than the value of their home. But 2 years ago, that was 30%. And when you can go down the list on various other things, the big changes over the last couple of years have made global investors pay a whole lot more attention to the U.S. than they were a couple of years ago. And their government deficits, which looked unsustainable, trillion-dollar deficits 4 years in a row in the U.S., have now come down to only $500 billion, still a massive amount of money, but certainly a huge improvement in the space of a couple of years. So when I go to London or into Europe or into the U.S. talking to investors, they're now seeing the U.S. as an investment opportunity. Money that might have come to Canada because we were doing so well is being diverted more to the U.S. One of the key reasons why the U.S. dollar is strong against the European currency, against the Japanese yen, against the Canadian dollar and the Australia dollar. So we think of our dollar as having weakened against the U.S. currency because that's the way we think of the Canadian dollar, when in fact the U.S. currency is now stronger simply because things are better south of the border. That's good news because, as I said, 74% of our exports go into the U.S. economy. If you go over to Europe, the European situation has been pretty uneven. A couple of years ago, most analysts were suggesting that Europe finally would get out of a very vicious recession, one that had been lasting longer than any one that they had seen since the inception of the Eurozone. And to give you an idea what that means, the youth unemployment rate in Greece and in Spain was over 60%. In Spain, it was in Italy, it was 40%. So there was enormous difficulties there. Governments had big debt. Their deficits have come down. They still exist, so their debt is still going up. But Europe is an old population, older population than in Canada. And the population isn't growing. Countries like Germany are seeing their population actually decline. So structurally, they were having a number of very significant problems. Cyclically, things seem to be getting a little better. And in fact, as I said a couple of years ago, it looked like the recession was ending. At the beginning of this year, we still had hoped that was occurring. But most recently, it doesn't look like it's going to happen. We are seeing signs of weakness in places like Germany and France and in Italy. Some of the other countries that have been fragile for a while are still relatively soft. The Italian youth unemployment rate is actually going up. It's over 40% right now, even though it's come down in some other areas. So in Europe, while there may be some signs of improvement over the next couple of years, hopefully, there are enormous structural problems. And many investors globally that thought that Europe might be a place to invest a couple of years ago because it was looking stronger are thinking less so. They're looking more to the U.S. again. And that's one of the factors that has weakened the euro and made the U.S. dollar stronger. The area in the world that people pay attention to other than the U.S. nowadays, though, is the emerging world economy, the Chinas of the world and India and the like. And the reason why that's the case is that they are driving global growth in a way that we never thought would be possible, say, 20 years ago. When you look at the way the world economy was being driven in terms of growth in 1990, countries like Canada, the U.S., Europe, and Japan accounted for 2/3 of global growth. Right now, the emerging world, countries that have not yet reached into the developed world economy in terms of status, are accounting for 2/3 of global growth. And they are growing much faster than Canada, U.S., Europe, and Japan. So that by the time you get into the workforce, the emerging world will not only be dominant in terms of global growth, it will actually be more dominant than it is today. And that's one of the key points I'd like to make is we think we've seen the world economy change a lot over the last 10 years. Just wait. By the end of this decade, we will see a world economy that is vastly different than we're even seeing today. Possibly because of technology, but most importantly, because there are new consumers globally, and those are the consumers that Canadian firms have to figure out how to reach and successfully market into their areas. Let me just give a couple of things that are going on in China right now that tend to be important. The first one is that if you end up working in the resource sector, so if you're working for a company that is in the mining sector, increasingly in oil and gas, in the agricultural sector, if you're looking at nickel, copper, zinc, iron ore, coal, potash, uranium, a wide variety of things that Canada produces and exports, Chinese market matters a lot, and the Asian market is very, very important. A good example of that would simply be the U.S. economy is recovering now. They're building more cars. That means they'll produce more steel. The U.S. produces 10% of global steel. That's very good for people who produce iron and coal. China produces 50% of global steel. So even though the U.S. is recovering, it's a Chinese market that matters. In manufacturing, things have changed as well. I was talking to the CEO of Boeing about a year and a half ago about where he saw his market growth. He was saying over the next 5 years, it was almost all going to come from emerging countries in Asia and Latin America. Sure, in Canada, the airlines are going to be buying new planes, and in the U.S. and Europe as well. But the real increase in demand is coming from countries that they really weren't selling to in large numbers 20 years ago. And in cars, the biggest market for cars in the world by far right now is China. So they sell more cars in China than Canada, the U.S., and Mexico combined, more than all the cars sold on the continent of Europe. It is also the fastest growing car market in the world because there's less than 100 people per thousand that have cars. In the U.S., it's about 750 cars per thousand or so. So it's a very unsaturated market. So where I come from in Ontario, where the auto industry has been very strong, traditionally GM and Ford and Chrysler have to have an Asian strategy or a China strategy, how you penetrate that market. You'd think, because income is pretty low on average there, $5,000 per person in China, that the type of cars that would really be in strong demand would be very inexpensive ones. But in fact, BMW and Mercedes have China strategies because China is actually the largest market for luxury goods in the world. China and India are the biggest consumers of gold in the world. And I could go on and on making those type of comparisons. But one of the ones that has really been startling over the last 5 years has been happening in international tourism. I talk quite frequently to international tourist groups looking at trends that exist, and I've been doing that for about 25 years. And 5 years ago, I would have said, okay, the top spenders in the world were the Germans, the Americans, the British, the French. 5 years ago, China was number 5. Last year, Chinese tourists outspent Americans, outspent Germans by $40 billion. And in most cases, families in that country have not really started traveling beyond their borders yet. So from a Canadian point of view, we want more Americans to come north of the border, spend money here and enjoy what exists in Canada. But since 1999, almost every year, Americans have been coming here in fewer numbers. We think we'll do better this year because the Canadian dollar is now below 90 cents. The U.S. economy is recovering. But if you're in the tourist business, the hospitality business, the real focus on a 5-year basis is going to be how you get people that have never traveled to your market destination before actually interested to come, how we get shelf space in that market and actually get them to come. So when you're looking at things like mining or manufacturing or services, the world has changed very dramatically. On top of that, we had a change in the investment pattern globally. For example, when the purchase of Nexen went through a little over a couple of years back, it was bought by an offshore company that was basically controlled by the government there. That was a rounding error in cash on hand in China, which has now $4 trillion worth of foreign exchange reserves. So whether it's looking at who will be investing in Canada or where our various companies across Canada are going to be marketing, or what is happening to the price of raw materials, which are one of our biggest, if not our biggest export. Energy is our biggest export by far. All of these things are being driven by markets that we haven't paid attention to for very long, markets that didn't seem to be that important 20 years ago, but will become exceptionally important on a go-forward basis. The reason why I'm bringing up this is that one of the things that's rattling financial markets right now is the fact that Chinese growth is slowing down. And I'll give you a comparison. In a good year, Europe will grow by 1 to 1.5%. We're worried that Chinese growth will fall below 7.5%. Okay? The difference is Chinese growth has been 10% on average since 1990. And it has been showing signs of growing as income is going up, as the economy becomes bigger in economic size, there's a natural tendency to slow down. What I really think is happening here is simply that the economy, as it gets bigger, is naturally going to go into a general glide to lower growth, below 7%, may even reach below 6%. But that doesn't mean there's less opportunity in those markets. That simply means that there are more consumers there, more domestic demand, a world of opportunity for many of the businesses that we have in this country. Let's go back to the United States for a second. And I don't know in your business courses where you actually look at what's been happening in current events in financial markets, but one of the things that tends to capture the imagination of financial markets right now is the type of monetary policy that has existed since 2008. And if you've taken an economics course and looked at what central banks do to get an economy going if the economy is slowing down, the economics answer to that would simply be to lower interest rates. You lower interest rates, people borrow more, they save less, they spend more into the economy gets going again. Well, in the United States, they were having severe difficulties, and the head of their central bank, a guy by the name of Ben Bernanke, decided to follow that prescription. The problem was he got interest rates, or the one he controls, down to zero, and the U.S. economy was not expanding. And on rethinking what should be done to finally get the U.S. economy out of its recession and period of slow growth, he decided he had to do something new. And the bold new adventure we embarked on was something called quantitative easing, which basically meant that the Federal Reserve began buying a lot of U.S. government bonds and treasury bills to lower interest rates. When I was going to school, that was called printing money because the government was actually selling its bonds to itself. We didn't call it printing money, we called it quantitative easing. But in reality, that policy was extremely aggressive and got longer-term interest rates down to exceptionally low levels. If U.S. longer-term interest rates go down, our 3-year mortgage rates go down, our 5-year mortgage rates go down. For businesses, the cost of borrowing in Canada goes down because our markets are very closely tied to what's happening in the U.S. So there was a large spillover from that policy in the U.S. to what was happening in Canada. The question is, where do we go from here? And we began to get an inkling of that in the spring of last year when Ben Bernanke, the head of the Federal Reserve in the U.S., said he was going to begin to cut back on that policy. Because last year, the U.S. Federal Reserve bought $1 trillion worth of U.S. government bonds and mortgage-backed securities, a massive amount of buying in order to get interest rates down. But with the U.S. deficit falling, in fact, it's going to be about $500 billion this year, that policy seemed unsustainable. The U.S. government, by the way, through the Federal Reserve, now owns 18% of its outstanding debt. And in terms of longer-term issues of government bonds, 10 years and over, it owns nearly 50%. So this policy was looking unsustainable. But the U.S., by following this policy, because the U.S. is the strongest influence on global financial markets, had the impact of bringing interest rates down in Canada, in Europe, and many countries around the emerging world, and bringing them down dramatically. So last year in the spring, when Ben Bernanke stood up and said they were thinking of cutting back, or what the markets called tapering, the world became a different place. U.S. interest rates began going up in anticipation, not a little bit. For some, I guess the mortgage rate in the U.S. went up 1 percentage point, but in Europe they were very worried that that would cause their economy to go back into recession. And for countries like India or Indonesia or Brazil, big countries with very heavy debt that had depended on very low interest rates, their markets became very, very uneven and volatile. So when the U.S. decided that it was about to transfer into a different type of policy, we began to see financial markets moving in a very, very nervous direction. Funny thing was, Globally, when the markets are looking a little bit unstable, you look for safety and security and liquidity if you're an investor. And that just defined what the U.S. Treasury bill and bond market is. So we found investors that were already interested in investing in the U.S. because the economy was recovering, now interested in going into the U.S. economy because it was safe, secure, and liquid in terms of investments. At the beginning of this year, the Federal Reserve actually stopped buying a bit of the bonds that it was purchasing, and by November they will be completely out of buying new government bonds and mortgage-backed securities. So the biggest buyer of U.S. government bonds in the world, bought $1 trillion last year, is going to zero in the year ahead. And my economics course, Economics 301, my money and banking course, told me that if that happens, interest rates would go up. That was the nervousness globally. Interest rates going up would slow down the global economy. Ever since they made that announcement, all this year, U.S. interest rates have gone down. And in fact, the reason why that is happening, the reason why the U.S. dollar is strengthening a bit, is the fact that global investors are now much more willing to invest in that economy, much more so than in Europe, and some emerging economies, at the margin Canada, and a few others as well. So let's get back to Canada, or let's get to Canada and see exactly what that means for us. First of all, on interest rates, if the U.S. Financial markets stay where they are today, we're going to have families that are interested in purchasing a house going to have relatively low cost of borrowing for mortgage rates. My sense is that interest rates are going to go up a little bit in the U.S., so I think there's a little bit of risk there. But the bottom line is interest rates over the next year to year and a half are probably going to stay near lifetime lows. For businesses that depend on something called the prime lending rate, or people that are buying a home using a variable rate mortgage, basically a mortgage rate that varies according to short-term interest rates, story isn't quite as straightforward. We had a change in the head of the Bank of Canada. A gentleman by the name of Governor Politz took over. His policy has been one of indicating that interest rates are going to stay down in our country because inflation is low, growth is slow, and because he is very sensitive to what is happening in our economy in general, he is not unwilling to see the Canadian dollar move to lower levels. The Bank of Canada doesn't target the currency, but things that they do and things that they say can have an influence. So going back to the Canadian dollar, why is the Canadian dollar lower? Number one, the U.S. is growing faster. As a result, investors are going there. Two, because China and Asia, and for that matter Latin America, have slowed down, commodity prices are softer. Canada is a commodity-rich country in a commodity-short world, and our currency is a commodity currency. So when commodity markets soften, you find that the Canadian dollar goes down, just like the Australian dollar goes down. When commodity markets were strong, the Canadian dollar was 102. When the commodity market softened, the Canadian currency went towards 90 cents, and over the last week or so has actually been below that level. The third reason why the Canadian dollar has been weak is that because Canada is likely to underperform the U.S. has already gone through its catch-up phase, and its employment is growing at 3 times what it is in Canada, 2 to 3 times. You are finding that the Bank of Canada may well lag in raising interest rates relative to what happens south of the border, and that also keeps the currency low. So if you're thinking of going south in the winter, and you're wondering when you purchase your U.S. dollars, and you're waiting for the currency to rally up to 95 cents or maybe even above, don't hold your breath. The fundamentals in commodity markets, what's happening in the U.S., and what's happening in our policy, all suggest that the Canadian dollar will tend to be soft, around 90 cents, in my view, even slightly below that level over the next little while. Now, going back into Canada, into the real economy, where jobs are actually being created, what is happening across the country? I've been doing economic forecasting and analysis for 4 decades now, and I have never seen the concentration of growth in as few provinces as is existing right now. Most of the jobs that have been created in Canada over the past 2 years have been created in Alberta and in Saskatchewan. It has been weak in most other provinces, just out in Vancouver, and the government is concerned about the very slow growth minimal growth of job creation there. Same sort of story for Ontario or for Quebec. I was in Halifax last week talking to the government. Halifax lost about 4,000, Nova Scotia lost about 4,000 people. Their population declined by about 4,000 people last year. You know, that population has declined in many instances. Of course, some of the decline has been embedded by people working in Fort Mac or in Alberta, simply leaving the province to find better opportunity. But it is an economy that is very skewed to the west. In fact, if you draw a line down the border between Ontario and Manitoba, every province to the west has a better credit rating, better fiscal prospects in my view, probably better economic growth on average, in other words, above the national average. I think BC is going to speed up, and overall better fiscal situation. So the economic geography of our country is changing very, very substantially. Now, when I look at it from an Ontario perspective, because as I said, I live in the Toronto area, that's not bad news at all. Because in Ontario, strong growth in Alberta, strong growth in Saskatchewan, various other places, tends to create jobs and opportunity in that province, in engineering and a whole lot of other ways. So as I look forward over the next 2 to 3 years, the bottom line in my view is growth remains best in the west, tends to be concentrated in Alberta and Saskatchewan. When I look out 5 years from now, the story is a little less certain. I mentioned earlier that energy is the biggest exporter of our economy. Back in the year 2000, energy and auto exports were about the same value. They were neck and neck. At that time, Canada had an auto surplus in terms of trade of about $20 billion. I mentioned Americans are buying more cars. We now have an auto trade deficit in this country of $15 billion. Even though the Americans are purchasing more, we're using more imported parts, and it effectively has not been as big a boost to our economy. The biggest export by far, vastly higher than autos, is energy. So the issue is, where are we going with energy on a go-forward basis? And we could talk about various segments. I mean, if you're in Saskatchewan and you're talking about uranium and looking where the demand is going to go in the nuclear business, many parts of the world have cut back down. Japan has closed down its nuclear plants. You are seeing in Europe, Germany has decided to move away from nuclear and go to renewable energy sources and some other sources as well. But if you're in the uranium business, the big growth is in 2 countries, China and in India. And they are going to be building at a fairly rapid rate. Outlook, in my view, is fairly positive for that. If you're looking at the demand for oil and natural gas on a medium-term basis globally, the demand is going to be very strong. Again, primarily the growth is going to come from Asia. If you're looking at agricultural products, whether it's grains or livestock, increasingly as income is going up, you are going to find that demand from people that can afford it in Asia and Latin America is going to underpin the agricultural commodity space. But in the here and now, the story is complicated in the energy side by something that has happened rather remarkably. If I went back 10 years ago and I was asking analysts what they thought about the U.S. energy industry, they would have probably told me every year from now on, the U.S. is going to be producing less oil, less natural gas. When I go to the U.S. right now and talk to analysts, they say every year from now on, the U.S. is going to be producing more oil and more natural gas. The revolution with respect to shale extraction through fracking and horizontal drilling has changed the balance in North American energy, so that in the next couple of years, the U.S. will become a net exporter of significance of natural gas. And while they still import a lot of oil, and in fact we're exporting record amounts of oil from Canada even as we speak today, at the end of the day we are winning because of market share. The U.S. is buying less from Africa and they're buying more from Canada. But over the next little while, each and every year, the U.S. is going to be producing more and more oil. And so all of a sudden, the center of the debate in the energy sector has shifted to where are we going to sell our energy resources. When I'm in BC, the focus is on natural gas. They've got a lot of natural gas and building in LNG plants. And pipelines to the coast and LNG plants is something that is a matter of fairly fierce debate. But it is a debate within British Columbia because they have the resource, they can build the transportation to their coastline. My view, next 2 to 3 weeks, we may well see some more encouraging news coming out of BC, although I've heard from many people in that province that positive news is imminent for the last 2 years now. But that will be a big deal because natural gas exports have gone from about 35 billion, primarily to the U.S., 4 years ago, to about 10 billion today, as the U.S. has been ramping up. It was our major market. When you look at oil, it's a bit different story because we in Canada and in the U.S. collectively will be the major source of new oil supply in the world over the next 5 years. But the trick is, where are we going to market it? Heard a lot about the Keystone Pipeline and whether President Obama is going to sign that, very important to Alberta, in getting heavier crude into U.S. markets, the U.S. South and refineries. And after the midterm elections, which are coming up in about a month, maybe he will sign it. But it is becoming less relevant because we've done workarounds with respect to transportation via rail and barge. And more importantly, the U.S. is in general producing more oil. What affects light sweet crude, that's what they're producing more of, and which is a big export for Alberta. So on net, in order to get advantages in the markets over the next 5 to 10 years in energy, Alberta and Canada more generally has to export that resource, not to the U.S., which is producing more, but to big market growth areas such as Asia, a little bit to Europe because of what's going on in the Ukraine, and other parts of the world. And herein lies the problem. You've probably read and seen in the media what was the big discussion that has occurred around Northern Gateway or Kinder Morgan, 2 pipelines from Alberta through British Columbia. The process has been lengthy. The outcome is currently uncertain. There is a proposal to bring Alberta oil through Saskatchewan, Manitoba, Ontario, Quebec into New Brunswick, so-called Pipeline East project, has a better chance. But still it is tied up in a number of delays. But these decisions around these pipelines will be very important to the outlook for Alberta, for jobs, for government revenues, for public services, 5 years to 10 years out. And in fact, if the ability to get the oil out is constrained in any way, growth here and growth in Canada in general will tend to be less. When I look at the growth of jobs over the next little while, I see it in the resource sector because we are a country that is very, very focused on the resource sector, but much more going forward in small and medium-sized businesses. Small companies that have a niche in technology or are offering a good or a service that is high value added. In order to produce that good, they need people that are trained here, trained in the educational system in Canada, that are much more specialized than in the past. Ontario, for a long time, has been driven by big assembly line production, such as autos. That type of production is no longer going to experience strong growth. In fact, think about a car that is produced now relative to what it was 5 years ago. What's different between those two cars? It's technology. It's the software that is embedded. There's not more steel or more plastic. It is the value added through technology. That is the area where we have to be able to compete. I have talked to auto parts manufacturers that are doing very well in various parts of the country, primarily in southern Ontario, and they are doing well because they are moving up the technology curve. So the future for Canada in terms of prosperity and growth is very much focused on energy right now. But the backbone for many of the jobs that are going to be created over the next 5 to 10 years is not necessarily going to be in the energy sector or in the resource sector. It's going to be more in the technologically focused industries where you bring a good or a service of higher value into the market. In the past, many of the industries that I have talked to have bemoaned the fact that the Canadian dollar was very strong and they were losing export competitiveness. If you are producing a high value added product, something that the world needs, a product that Apple wants, or a product that Samsung wants, for example, the exchange rate is not the issue. The issue is the value of the good or service itself. Am I optimistic about where we're going? I talk to small and medium-sized businesses right across this country virtually every week, and I am absolutely astonished at how well many of these industries are adjusting and doing in a more competitive world environment. They are exploring the new markets of the future. It's the Wayne Gretzky example of going to where the puck is going as opposed to where it is right now. They have figured that out, and they are positioning themselves to be successful there. If we can continue to do that, I think we can do very well. If we rely on old ways of doing things, old strategies, I think we're going to find that growth in this country will be slower. Now, that's just a general overview. You guys are probably interested in a whole lot of other things. And if I can open it up to questions, maybe I can get at some of the issues that you might be interested in. Yeah, can't see because I'm looking into the lights, unfortunately.
How much is economic growth tied to population growth? And as population slow down, are we going to need to rely on immigration to kind of that?
So the question is, how much is economic growth dependent on population growth? And the answer is a lot. So for example, when I said that 1% growth in Europe is good, primarily their population isn't growing, growing very rapidly, so that takes out the dynamic of added market growth out of the equation. In Canada, population growth has already slowed, but it varies a lot according to area. In Alberta, the population growth last year is a little over 3%. In BC, it was 1.2%. In Ontario, it was 1%. In Saskatchewan, it was 1.7%. So if you're looking at the potential to create jobs, the differential growth in favor of Alberta and Saskatchewan, whether you're in the retailing business, opening a restaurant, whether you're looking at a wide variety of other things, opening rival companies in the discount, a retailing business and the like, is very, very much oriented towards that. Looking at it, I think, from what you're talking about, and that is the supply side. In other words, are we going to have enough people that are actually going to produce the stuff that we need to export and drive growth? The answer is a little more difficult, and that's a big debate in this country. It is about temporary workers coming in to fill jobs that Canadians don't want to fill. It is about training skilled workers that can actually do the jobs that are needed in much more technologically advanced areas. The immigration side of things helps a little bit. You can bring in skilled individuals. You can bring in larger population that essentially gets Canadian growth a little bit stronger. But it's not a panacea. Right now in Canada, we have, on average, about 250 or slightly more, 250,000, slightly no more immigrants coming in. And that is creating demand for housing and services and the like, and it is bringing some skills. But at the very core of meeting our skills requirements is not bringing in the skills, but basically training Canadians to have the skills. I do a lot of work on the educational front and talking to governments and the like. And the one point I continually stress is that we really need to focus on the skills levels of the average Canadian population. There are certain esoteric skills that receive a lot of support. But the real issue is to bring the average skill level higher so we could take advantage of what's happening in markets abroad, having the right skills to produce the goods that are increasingly going to be in demand. This is a big issue in many countries. If we don't do it, effectively income disparities are going to be widening. They've been widening in the US for some time. They're about to widen a whole lot in the European situation because of what's going on. We do not want to go there. And so in order to meet the skills requirements, I think we have to very, very much focus on the educational positives that we can bring to the table and the educational outcomes increasing. When I was graduating, a 3-year BA was a good thing, because effectively most of the population that was in the workforce had a high school education. So 3-year BA was actually quite positive. If you had a skill, you were golden. Carpenter, bricklayer, pipe fitter, you go down right down the list. Nowadays, that has changed, and we are finding more and more people that are entering the educational system post-secondary are staying longer and longer and taking a circuitous route. I'm on the board of a college in Ontario. The average age of intake for the first year is 24 years of age, and many of the people that are coming in have already been to university and got a BA or whatever, and they have come back to actually get a skill, a specific skill that will allow them to work in the workforce. We have to streamline that. We have to make our educational system more student-centered. Alberta is making progress in that area. BC has actually done a very good job in mapping colleges and universities and skills needs. Ontario is behind in that particular area, but I believe it is job one in terms of the government, in terms of improving that.
So do you think educational institutions are doing a good job of training people to meet the needs of your job? Or are there particular institutions that are doing a better job?
I think it's a government priority. I think as you go institution to institution, you will find areas of excellence, and you will find areas that are just going into the stream. Most people, when we talk about skills, think about the hard skills. One of the skills that tends to be in very short supply is entrepreneurial skills. So that when I talk to many students, they're talking about who they will work for. They're not thinking about what job they will create for themselves through the company that they're going to set up. And I think that's an area where we have to have more focus on. I was talking to a group of deputy ministers of education last winter, and they were talking about issues in post-secondary education. And they wanted to know, well, how do we figure out how many carpenters we're going to need 5 years from now? You can't. There's no way in the world that we can forecast the economy with that degree of effectiveness. But what we have to do is focus much more on the skills levels themselves, the general skills levels, the resilience, the adaptability, and training to work in a business environment. I believe in co-op programs as being one of the best ways to get people into the workforce. I believe that should start before you leave the high school environment. In other words, that transition, I think, has to be made a whole lot easier. Yep.
Can you comment a bit about the real estate market? The banks have been reducing their mortgage rates, which means the housing prices are going up. I'm guessing you guys are very optimistic about the real estate and the public is not going to burst. But the Ministry of Finance thinks differently, right? So what do you think? Is the Ministry of Finance seeing the black swan that you guys aren't? Where do you see the real estate market in the next couple of years?
The question is around bubbles in the real estate market and the difference between the finance department and being more cautious on the outlook and other analysts that are more positive on the outlook. You also asked about black swans and whether the finance department, you can't see a black swan. If you could see a black swan, it's not a black swan. But that's another issue. But we do get hit by very unexpected events. The financial crisis in 2008, a lot of people thought would happen, but not nearly in the way it did. That, in my way of thinking, was a black swan. I've spent a lot of my time over the last 5 years trying to explain to people why there isn't a Canadian housing market. You know, there's a Medicine Hat housing market. There's a Vancouver housing market. There's a Calgary housing market. It's all very local. And one of the things that has driven the market is lower mortgage rates than we have ever seen in our lives, because the Federal Reserve and many other central banks around the world work very hard to get interest rates down. Low interest rates are a bonus to borrowers and a penalty for investors and pension funds, people that are getting ready to retire and finding that the rates of return on their investments, we won't go there, I'll stick with the housing market, so it's a two-edged sword. But when I look at the markets that people are worried about, they tend to focus on Vancouver, the Lower Mainland, and on Toronto. I talk to developers all the time in both of these markets and other areas as well. And when I look at things that tend to suggest problems, they're not there. High vacancy rates, not being able to sell as you're building. In other words, not having a large percentage of the units sold before going in. Both markets are very specific. Both markets have a very a high-end market, which is based on wealth. That depends on offshore investment as well. But in both cases, I am not that worried that we really have something that is going to lead to a big setback. The two things that would really cause the housing market to move strongly in reverse would be job creation stalling and actually unemployment rising. People don't have money, and therefore they wouldn't be purchasing houses, and interest rates rising dramatically. Neither one of the two seems to be happening right now and likely to happen over the next couple of years. Longer term, I expect interest rates to go up. We're seeing job growth slow, but we're still seeing relatively strong job growth. In Alberta, the dynamics, 3.5% population growth, suggest a pretty solid housing market in general in the province, but it'll vary from place to place. One of the things that is happening, and this gets it a little more negative in terms of the story, however, is what is happening for first-time home buyers. First-time home buyers typically are in the 25 to 35-year-old age group. That age group, there has been very little job creation on net since 2008. It's been solid here, it's been negative in some other areas, but on balance it has been slow. The government has reduced the time in which you can finance a house from 40 years down to 25 years. That increases the cost to purchase for the person that's going into the market. The government has made the 5-year posted mortgage rate a rate that people have to be able to qualify under given their finances. That rate is over 5%. It's not where you see the market rates if you're looking at the media. It's much, much higher. So we're finding that the first-time buyer is more constrained. And if you want a vibrant housing market, you need the first-time buyer in order to have the move-up buyer actually move up to something else. So what I see, particularly in markets like Toronto and Montreal, is that we may well see a slowdown there in first-time home buying that makes the market move sideways and perhaps goes into a bit of correction. In Vancouver, there's still a worry there, but I think the market fundamentals are a little stronger and they're much more driven by foreign investment. That's my housing market story.
Well, take China as an example. Do you think it is a healthy sign for them to use the growth of GDP compared to other countries like 1 or 2% growth?
Now, I didn't catch the first part of the question, and could somebody put up their hand when they're talking, because I cannot see with these lights. I'm not sure who's even asking that question. Where are we going here? Ah, okay. So what was the question again? I'm sorry.
Well, take China as an example. Do you think it is a healthy sign for them to have more growth in GDP compared to other countries like Japan or Europe, like 1 or 2% growth in GDP?
Yeah, the question is it healthy for a country like China to have 7 to 7.5% growth when Europe is only having, let's say, 1% growth at best? And the population dynamics aren't that different, by the way, because population growth is very, very soft in China because of a one-child policy, and the demographics are actually going to worsen a whole lot as we go forward. The difference, however, is the amount of people that are in the market economy. So you've still got 250 million people or so in China in rural environments that have not participated, and they're still in the agricultural sector, and they have not moved into the market economy in the large urban areas. And that transfer is occurring at a very large rate, and it is probably going to continue to. That drives growth. In other words, you are taking people that have never consumed things before and making them consumers, whether it's energy or whether it's resources or whether it's services. And that process tends to make growth stronger for a longer period of time. But as China develops, you inevitably see the growth rate slow. So as more and more people are in the market economy, you will expect that growth rate to go down. And I think the markets are not fully understanding that as an economy matures and becomes more developed, you're not going to see these type of growth rates. And they they will slow very significantly. Now, if you look at it from another perspective, what does that growth mean for a whole lot of things like environment and the like? Bringing that many more consumers into the marketplace creates enormous challenges. So if you have an economy that basically isn't growing a lot and is focused on improving environment through a variety of initiatives, you would actually have a smaller environmental footprint of their population. But even if China improves substantially energy efficiency and a whole lot of other things, they are still seeing massive amounts of new consumers coming in. And that is a big challenge for China, for Asia, and for that matter for the world, is actually dealing with a population that big that is growing that rapidly and likely to grow at a pretty rapid rate over the next 5 to 10 years. Any other questions? I think we've exhausted all questions. Thank you very much. Oh, there's one more? Okay.
Yeah.
Also, what do you think about the exchange rate observed in dollars compared to the US dollar?
The Canada-US. As I said, given the things that are going on right now, commodity prices are a little softer. We're going to have the U.S. Attracting more foreign investment. Bank of Canada policy is likely to be accommodative for longer than Federal Reserve. We're going to see the Canadian dollar weaker for longer. In other words, 90 cents, maybe a bit below. If I'm looking out 5 years, we still have a better fiscal situation, in my view. We still have a stronger banking system. We top all the polls in this particular regard. We also are a commodity-rich country in a world that will be demanding commodities at a very rapid rate over the next while. This goes back to the 7% growth in China and the 5.5% growth in India, and in general growth in Asia that is double to triple what we're going to see here. So in that environment, I would say as we go towards, the end of this millennia, or the end of this decade, we will probably see the Canadian dollar back on a stronger footing. We do better in a lot of measures that would suggest to me that the Canadian dollar will rise once the U.S. has gone through its initial expansion stage and has begun to slow. So I'm still longer-term bullish on the Canadian dollar. And one of the reasons why I think we have to move up the value-added curve is if the dollar begins to rise, of course, that puts a lot of stress on producers of relatively low value-added things that are exporting into global markets that are in U.S. dollar prices. When I travel around, I would like to make one point, and because that's all I do is travel. From roughly September until June of every year, one of the benefits is meeting an enormous amount of businesses that are very innovative and doing well. But as I travel into the U.S. or I'm traveling into Europe and then I come back here, I'm always struck by the fact that we really do live in the best country in the world. I mean, we can argue about some of the problems, we can focus on some of the risks, we can listen to too much media that are pointing out the problems that we have. But we've definitely won the reverse beauty contest. We're less ugly than other countries in almost every economic area that I look at. Fundamentally, we've got a lot going for ourselves. The world is changing dramatically, but I think we've got the fundamentals that will allow us, our industry, our businesses, our employers, our employees, to adjust to that change. Thank you very much.